The psychology of illiquidity, why micro-investors underestimate it. Introduction: the illusion of comfort until you need cash. Illiquidity is often described in elegant financial terms. It is framed as a premium, a trade-off, a rational acceptance of delayed gratification. Micro-private capital investors frequently claim comfort with it. They are not traders. They are long-term builders. They do not need daily pricing. And yet, when illiquidity becomes real, when capital is locked longer than expected, when exits delay, when distributions stall, the psychological strain surfaces. This essay explores why micro-investors consistently underestimate the emotional impact of illiquidity, and why that underestimation affects decision-making more than most will admit. Illiquidity in theory vs. illiquidity in practice. In theory, illiquidity means capital is committed for a defined period. Returns arrive later. Interim valuations are not actionable. In practice, illiquidity feels like lack of control, absence of optionality, deferred reward without certainty. Micro-investors often approach deals believing exits will occur within a broad window. 3 to 5 years. Perhaps 7. When that window stretches, discomfort grows. The issue is not financial alone. It is psychological. Humans are poor at waiting without feedback. The valuation vacuum. Public markets offer constant signals. Prices move. News flows. Liquidity reassures. Micro-private capital offers none of that. Valuations are periodic, negotiated, and often optimistic. When performance stalls, there is no immediate price correction. Instead, there is ambiguity. Ambiguity creates mental friction. Investors ask: is it temporary? Is it structural? Should we intervene? Without liquidity, doubt has nowhere to go. It lingers. This vacuum can lead to overreaction internally, even if nothing has materially changed. The opportunity cost effect. Illiquidity becomes particularly uncomfortable when new opportunities arise. An investor sees a compelling new deal, a favorable macro shift, a personal liquidity need. But capital is tied up. The frustration is subtle but real. It reshapes perception of existing investments. Patience becomes impatience. Assets once viewed as long-term plays begin to feel obstructive. The psychological shift from strategic hold to capital trapped is rarely discussed, but frequently experienced. Identity and control. Micro-investors often pride themselves on being decisive and active. Illiquidity challenges that identity. When you cannot exit, cannot rebalance, cannot hedge, you confront a loss of agency. For investors accustomed to influence, this can be unsettling. Illiquidity is not just financial immobility. It is psychological restraint. Distribution dependency. Many micro-investors rely on periodic distributions to recycle capital, demonstrate progress, maintain morale. When distributions slow, confidence wavers. Even strong portfolios can feel stagnant without cash returning. This shapes behavior. Investors may push for premature exits, resist necessary reinvestment, avoid long-term strategies that delay cash. The irony is clear. Illiquidity, accepted intellectually, becomes destabilizing emotionally. Why it is underestimated. Illiquidity is underestimated because it is framed as a premium, not a cost. It is experienced gradually, not abruptly. It lacks immediate feedback. And because early successes mask later discomfort, the first few exits feel rewarding. Delays seem temporary. Confidence builds. Only over longer cycles does the true psychological weight emerge. Conclusion: illiquidity requires emotional capital. Micro-private capital requires more than financial capital. It requires emotional capital. Patience is not passive. It is active restraint. It must be maintained, reinforced, and sometimes defended against your own instincts. Investors who acknowledge the psychological cost of illiquidity manage it better. They reserve liquidity. They communicate expectations clearly. They resist reactive decisions. Those who deny it are often surprised when pressure arrives. Illiquidity is not a flaw. But it is not free.